Hello, and welcome to the 2018 SEC Update. I'm Aaron Kofira, a partner in the Professional Excellence Division, and will be working through this topic over the course of the next hour or so. As a reminder, there will be codes provided throughout this course, and you'll need to make note of what those specific codes are. Separate instructions will be provided to you to be able to put those codes in order to receive your CPE as part of this recorded webcast. With that in mind, let's go ahead and take a look at our agenda and the items that we're going to be covering together. The first one will be our PCAOB inspection. As many of you are aware, we actually have experienced a PCAOB inspection in the month of August, and we'll go ahead and go through the preliminary results of that inspection, as well as to where we stand in the overall process and the future procedures that we're going to be doing as a result of that inspection. We'll also spend a few moments talking about the engagement quality control review process. I know a number of you on this call are very familiar with that, so it'll really just be more of a refresher course more than anything else. There's nothing really new to report, no new guidance or anything to note of that. It's really more just a refresher for those on the call, as well as to bring anybody that may be new to the SEC world, kind of just giving everybody an idea as to what's being done as part of that overall review process. We'll also spend some time surrounding professional skepticism. It's always on the forefront of the PCAOB's mind and the SEC's mind that as auditors we need to be diligent and definitely challenge our clients in their assumptions that they are making. So we'll spend some time looking at that SAP 10 as well. We'll also look at PCAOB independence rules, because those are always important to us as a firm, us as a profession, and there continues to be a lot of activity from the PCAOB world surrounding findings that they have as they go through their inspection process. And then at the end of the presentation, we will go ahead and talk through some of the PCAOB inspection reports from specific to broker-dealers and what is new within the broker-dealer world as to findings that they're having as part of their inspection process. From a firm perspective, during the week of August 20th, we had an on-site review this year, which was new for us. Generally, we've had the PCAOB inspection, and it's been remote. This year was different. We actually had 3 individuals that were on-site, as well as 1 individual that was off-site, and looked at all of our work papers. Now, as part of that review, there were 3 engagements that were selected, 2 of them being financial institutions and 1 of them being an employee benefit plan engagement. That being said, there was also a significant review of our overall quality control procedures, as well as our policies and procedures relating to independence. So it wasn't just a specific engagement, specific review. It was very similar to a peer review, but obviously a little more intense and in-depth, because it only focused on 3 specific engagements. As part of that process, they did identify 5 comment letters, is what they're called. Now, there's only 4 things on the screen, and the reasoning is they issue a comment letter for every engagement. The loan reconciliation process was noted on both engagements as a finding, and then they had journal entry testing as a finding, materiality, and investment testing. And we'll get into each of these findings in a little more detail. We'll spend some time looking at the specific PCAOB guidance that was referenced as part of the engagement and finding, and we'll also kind of touch briefly on the overall implementation plan that's currently being proposed by us as a firm. That's going to be at a very high level. More detail will be forthcoming as we move through the remediation process, as well as at the financial institutions meeting in the next month or so as well. That being said, the current status of the review is we are waiting for our draft report. We have gone through the inspection process, which is step 1. Step 2 is then they issue comment letters, which they indicate what their findings are, and then we will reply back if we agree or disagree with those findings, as well as agree to the overall facts of the findings. And then they issue a draft report, which includes the specific findings, and it's what you see on their website. So if you go on and find the firm's report, you would see a finding per se that will relate to each of these included within their report once that gets issued. Then they will go ahead, and once they issue the draft report, we will have a year to remediate findings, and that remediation process will go through the PCAOB, where we will work with an individual at the PCAOB to show the changes that we are making to our procedures, as well as, in some instances, depending on the timing, what those changes have been and what they are. And then we will go ahead upon that, and then if they're comfortable with our findings and our remediation, go ahead and issue the final report and indicate that there is no QC criticisms, if you will, and that we have remediated everything in accordance with their standards. It is important to note that although that there may have been comment letters that were issued, that does not mean that we had deficient audits or that the work that we did was not appropriate. It's really just areas of improvement, and where they believe that we did not 100% comply with their auditing standards. We do not believe that any of our audits are deficient or that additional procedures need to be performed to support the specific work or the audit reports that we do have out there currently. So it's just important to note that while these may be findings, they don't indicate that we have a busted audit, if you will, and that there's issues that need to be remediated and we have to recall audit reports. That's not where we are at from that perspective. So if we go into the first issue that is out there, that the first comment letter that was issued, there's actually two of them, as I alluded to earlier, and this was on both of our financial institution clients. It is really around the existence and completeness of the loan population and the lack of documentation over the use of negative confirmations. Currently, the way that their audit was designed was that there was negative confirmations that were sent, and the reviewers took exception to that use of negative confirmations, specifically over the approach that positive would have been better, as well as the fact that we did not obtain a complete and accurate population and didn't do enough to address those specific requirements over the existence of those loans as a result. So on a go-forward basis, and again, more of this will be talked about at the Financial Institutions Conference in November, or depending on when you listen to this, has been discussed at that conference. The positive confirmations will be used for all loans and deposits on a go-forward basis. This will obviously mitigate the negative confirmations from an existence perspective, because we will, when we send positive confirmations, the expectation is we're going to get that back, that confirmation back, whereas under negative, you send them out and you don't look to get any of them back. So we would expect to gain additional comfort over the existence, because there would be a reply received back. And then from a completeness and accuracy perspective, we'll be looking at, depending on the client, what type of controls and what type of systems, and designing specific procedures to mitigate that finding as well, as it relates to the completeness and accuracy of the data. One thing to note for completeness and accuracy is it's going to be something that you will hear a lot on this call today. It's one of the PCAOB's hot buttons that they are focused on. Is really, they're really hot and heavy on completeness and accuracy of data and populations. So that will be something that you probably will see throughout this presentation on a number of different slides. So just keep that in the back of your mind as we move along here. This is the specific guidance that was cited as it relates to negative confirmations. Combined assessed level of inherent and control risk is low. These are the three main items when it comes to negative confirmations that need to be used to be able to use them in a situation such as this one. The large number of small balances, there's a large number of small balances involved, and the auditor has no reason to believe the recipient of the request are unlikely to give them consideration. So again, we had documented A through C in some way, shape, or form. The clarity of it is a judgment call, and so there was a little bit of discussion as part of the review as to whether or not we had done all of that. And again, in our mind, we did do this. The one of the comments that we did receive back for letter C is that we didn't have a robust analysis performed. We were looking at potential history of what type of response rate we had received back. So at this point, again, I think the thought is we're just going to do everything as a positive confirmation and kind of take this off of the table versus continuing with this overall practice. The next piece of the standard from the inspection is, again, this completeness and accuracy. When using it, so this is not just applicable to loans receivable. This would also be something applicable to any any employee benefit plan engagement, any broker-dealer engagement, any engagement that is PCAOB driven. This is not a specific finding to the financial institution's loan and deposit reconciliation process. This is something for all information. We'll see it in a future slide here as well, specific to journal entries, that when we're using information produced by the company as audit evidence. So if we're using it for, let's say, testing of investments on an employee benefit plan or fixed assets on a manufacturing client, the auditor should evaluate whether the information is sufficient and appropriate for performing procedures of the audit by performing procedures to test the accuracy and completeness of the information or the controls over the accuracy and completeness of that information. So what does that mean? What that really is focusing on is, are we looking at the controls, such as IT controls, over the accuracy of the information that is coming out of the system? If it's being dumped from into an Excel spreadsheet, is there controls over that, or just a system generated report? What are the controls over the information that's coming out of that system? And then also evaluate the information is sufficiently precise and detailed for the purpose of the audit. So what does that mean? And that really is looking to ensure that the information can be used and is relevant to the specific assertions that we may be testing and looking at from an audit perspective. The next specific comment letter that we did receive an item on was on the journal entry testing side of the house. And again, this is that no evidence of completeness and accuracy over the population. The issue that they had on this specific engagement was the fact that there was no testing on the specific completeness and accuracy, obviously. The one thing to note here, this was a unique situation. For the majority of our clients, they have a SOC 1 report that looks at all of the IT controls. And in this instance, this issuer did not have a SOC 1 report. And included in that SOC 1 report, a lot of times, is a specific control that looks to the completeness and accuracy. And that's really probably why this was isolated to this one issuer client, was because that issuer client does not have a SOC 1 that is done. So as a result of that, the PCAOB made the determination that we did not do enough from a completeness and accuracy side of the house to get over the hurdle as it relates to journal entries. So from a remediation perspective, we're going to do some additional enhanced cutoff procedures, as well as do additional work around IT and system generated reports to gain that comfort from a completeness and accuracy perspective. And all of these specific findings, as they relate to the specific engagements, will be handled at the engagement level. So the engagements will be identified and will be discussed with the engagement partners to ensure that there are procedures that are implemented to remediate these findings. The specific PCAOB guidance as it relates to journal entries is found in PCAOB AS 2401, paragraph 58. I just want to call your attention to the main 4 items down below as to really, from a journal entry perspective, making sure that these are what we should be looking at and our procedures are addressing from an appropriateness as it relates to specific journal entry testing. And one of the places that this is often found is in PPC within CX 4.2.3, the financial statement reporting system documentation, within the financial close and reporting process. So it really looks to ensure that we have the documentation of management's process and the understanding of the close process, that we're looking at those journal entries to a very finite level, that we're determining the timing of the testing, be it at year end or during the interim quarters that may be applicable for issuer clients, as well as that we're talking to the appropriate individuals to try and identify any unusual or inappropriate journal entries that may have been performed. And a lot of times this is done, as indicated here, right within our fraud inquiry procedures. So when we do our fraud inquiry procedures, one of the questions is asking if they are aware of any potential fraudulent journal entries that are being made by management. And that's why it's definitely important and that we do talk to individuals outside of the normal finance arrangement, and do talk to some operations individuals. And I know for our financial institution clients, we definitely have had to enhance those procedures over the course ensure that we are going to individuals that are outside of the general finance operations and are more operational driven more than anything else. As I alluded to earlier, this is the duplicate slide from earlier as it relates to the completeness and accuracy for journal entry testings, and again with any sort of testing that is done, any kind of information or system generated reports that may be coming out of the company's systems, that we're making sure that we're identifying them and doing some sort of testing on it from a completeness and accuracy standpoint. The next comment letter that was received from the PCAOB was surrounding materiality, and really just to boil this down, the main issue that they took away from this was relating to the fact that there was no consideration in their eyes on net income, and that they believed that we did not document why we didn't consider net income as part of the overall materiality calculation. So the simple fix here is that we're just going to have some enhanced documentation within the materiality spreadsheet, which is found at CX 2.1 within PPC. So the first code that I'm going to give you today is going to be S as in Sam. Again, the first code is S as in Sam. From a materiality perspective, this is the PCAOB AS 2105. This is the consideration language as it relates to materiality. And I think, to be frank, our one hang up on this is that their criticism of our overall testing was that we did not specifically say net income is X and our testing materiality is Y, and we don't believe that it's sufficient, and we believe that it's okay to be higher than net income because of these reasonings. And I think our hang up on this, and our definitely we had a lot of discussion with this, and it was also part of our comment letter, is that in their standard it just says to consider the company's earnings and other relevant factors. It does not say you need to document why you're not testing at that net income level. But ultimately, it's one of those things where it is a judgment call, and could our I think where we're going to end up landing is that our documentation could be enhanced, and that there will be some additional enhancements to the materiality calculation and spreadsheet. But overall, again, I think our materiality levels in our eyes are appropriate. It's just a matter of maybe some enhanced documentation. Again, this is just an additional slide as it relates to materiality and items that are clearly trivial, so I won't spend much time on that. Again, as I did note that our documentation will probably just be enhanced on this to kind of lay out why we believe we're testing the appropriate levels. There was a finding as it related to investment testing. One of the issuers had a investment that was tested. It was a hard to value investment, and as a result we relied on management's use of the Bloomberg terminal, which was an appropriate function. However, we did not look at the specific inputs and outputs that were utilized as part of that valuation. So going forward, we're just going to go ahead and test some of those significant inputs on those hard to value investments. So it's a pretty easy fix from a remediation process. The specific standard that does talk about the accounting estimates are included here, and it's really looking at the key factors and assumptions. And I think a lot of you are familiar with this based on the remediation that occurred as related to the loan loss calculation, of looking at outside factors and looking at the overall inputs that go into those specific calculations. So again, those specific inputs and key factors look at the significant accounting estimate, the sensitivity, if there's been any changes to the historical inputs of that, what are driving those historical inputs, as well as anything that might provide us with some sort of bias or issue or misstatement, in the sense of is it if they're using the wrong input, is it going to cause an issue in the overall financial statements or drive the value the wrong way? That would be something that would have to be considered as part of the overall process and procedures. So this ends the specific overview of our internal or our peer review external inspection. And again, I think once we get that board the draft report we'll start working on. We will be able to respond to that draft report, and we will, and then we'll go ahead and start the remediation process shortly thereafter. So just stay tuned on that, and obviously something that we will work through and kind of go from there. From an other findings perspective, these were not comment form driven issues, so there was no comment form that was issued on these, but it's something that we took away as something that we need to improve on and enhance our documentation on, because in the future when they come back, and they will be back, it's something that they probably will look at and see if we've made anything or done anything on, and if we haven't, they probably will elevate it to a comment letter form. And this was the independence letter, and this hit not only the issuer clients but also the employee benefit plan clients. There needs to be some more formal documentation of discussions that have occurred with management as it relates to the independence letter. On the specific independence letter, we had indicated that we would be more than happy to discuss any independence matters with you. In accordance with the PCAOB standards, we need to indicate what that date is or document the substance of those discussions. So it's important to note that we really should be indicating the date that we're doing that right in the letter, and that is in the letters CX 5.3 and 5.4 of the PPC PCAOB templates. From a required communication letter, I know for a lot of our banks, as well as our employee benefit plan engagements, we use internal templates, which are very specific, a lot more specific than PPC's general templates. And I think this was recognized as a positive by the inspectors, and that we are being to such a granular level of detail when it comes to the risks as part of our audit. The one comment that they did have was to make sure that that we reconcile any significant risks within the risk assessment to ensure that we're identifying it within the required communications letter, and vice versa, so that if we identify something within the required communications letter that's deemed to be a significant risk, and our risk assessment needs to reflect the fact that that is a significant risk. So just being very careful and being very specific as it relates to these items to make sure that we are appropriately cross-referencing them, so that we don't get tripped up by including something as a specific risk within the risk assessment and then not getting it in the required communications letter, and vice versa. And then the last item that they had was kind of specific to the employee benefit plan testing that's performed, and this was surrounding some of the dividend income testing. The dividend income testing that was performed, as well as the normal income testing was performed, all that testing was performed in the month of December. And the one item that they had was of comment was that, well, your financial statements are for a full year, 12-month period. So really you're only testing 1/12 of the dividend income for the year. So from a testing perspective, we should be testing other months besides just December. So maybe we test on a quarterly basis or semi-annual, but it shouldn't. All of our testing shouldn't be focused just on the end of the year testing, because it is a test that dividends do come in throughout the year. So it's something that we need to be aware of, and kind of just relook at that as part of our overall testing process on a go-forward basis. The PCAOB inspection, this is actually the top 10 items that they keep finding as part of their inspection process. This is not anything, some of these you will see that may be applicable to us as part of our inspection process, but a lot of these are not, or may not have been items that were either focused on as part of their review or were comments that they had on us. Again, these findings here are on their overall general process and inspections globally. So these items that are included on these next few slides are captured from one of the trainings that they did, one of their small business forum trainings that they had. So some of these will overlap on findings that we had, and some of them will not. But it's just ones that do not are definitely important to keep our eye on the ball, so that we don't fall down as part of the next inspection process by maybe hitting one of these items inappropriately. So to dive in on the confirmation process, couple things that they did note or have been seeing is that failure to maintain control of the confirmation process. So they may make the selections, have internal audit, do all the testing, and are not controlling it. So we obviously have to control the mailing of those confirmations and the receipt of those confirmations. And then failure to address the exceptions. So if they received a confirmation back where there was an exception, they didn't do anything with that exception. The engagement teams may have just gone ahead and just put it in the binder and ignored the fact that there was an exception. And there needs to be some sort of follow-up work on those exceptions that are identified. The identifying the risk assessment, and I think we did actually have this as one issuer client. There was an issue where we failed to assess risk at the financial statement level and the assertion level. It was only done at the audit area level. So if there is a significant risk identified, we need to ensure that or a fraud risk, it needs to be the risk assessment needs to be completed at the assertion level and not at the audit area level. And I think this was something that we talked about last year as part of our peer review as well. And just to kind of go off on a tangent a little bit from a peer review perspective, this is something that not only our peer reviewers, but all peer reviewers are under a lot of pressure to ensure that the risk assessment really ties into the work that's being done, as well as to a lot of the testing and overall financial statements. So it all ties together. So definitely an area we can all improve on. CX 7.1 is obviously the risk assessment piece, and this is where we do all of our risk assessment testing. So just important to keep that in mind as we move forward throughout not just our PCAOB audits, but also our normal non-issuer client audits as well, to make sure that all that testing is tied together. Audit sampling, this is something that's always a hot button. 8.2 and 8.3 provide the PPC programs for audit sampling. There continues to be failures of firms not appropriately determining an appropriate sample size when it comes to testing of either controls or substantive procedures for their testing and engagements that they're performing. Substantive testing, a lot of times the substantive analytical procedures, if you are performing substantive analytics, you need to develop expectations, look at the differences, test controls, and a lot of that's not being done on various engagements. CX 8.1 and 9.1 are a couple of tools that may be beneficial for engagement teams that have these type of substantive analytics to consider using as part of complying with the AS 2305. From an audit evidence perspective, obviously I think this is there's the accuracy and completeness again. A couple of our findings probably could go into the audit evidence finding bucket, and actually you've seen this 1105.1 earlier in the presentation. So here it is again. This is kind of where making sure that we are looking at all the completeness and accuracy of the information. This slide I'm not going to spend barely any time on because this was specific to integrated audits, and we only currently have one integrated audit per se from a PCAOB issuer perspective. This is not to say it's not any of the FDIC review, the fiduciary reviews, but these are some of the findings that they are having for integrated audits are very appropriately test controls, looking at the operating and efficiency and making sure that the procedures support that, and then relying on substantive evidence of controls instead of actually testing the individual controls for effectiveness. So those are just a couple findings as it relates to integrated audits, and hopefully we will not be inspected during a period of the integrated audit, but you never know. So accounting estimates, again, I think the marketing management or the investment one probably would fall into this, the failure to look at the assumptions and inputs on an estimate, and then also the accuracy and completeness of the data, again, hot button, right? Looking at the fair value measurements and disclosures, again, a hot button of testing the data and underlying assumptions, and then also looking at for fair value and for the overall disclosures as well. The audit risks and risk of material, so of material misstatement, again, this is going back to the falling down on the risk assessment procedures that are out there, and also looking and ensuring that if we do, as a reminder, if we do, focusing on the last bullet, if we do mark control risk as less than high, the expectation is that we've done some sort of testing and audit procedures over those individual controls in the system to make sure that they are truly less than high. So as a result, if you mark anything on your risk assessment as less than high, you need to go test controls, and that brings into play making sure that you have the appropriate sample size and ensuring that all your documentation is in order from a testing perspective. And then last but not least, the evaluating the audit results. This is a very broad category, and it looks to a lot of the disclosure failures, potential going concern issues on maybe potential benefit plans that you may have. Is there any indication of going concern, and if so, is there documentation over that failure to either include disclosures or to are those disclosures appropriate and adequate within the financial statements? And just ensuring that everything, it's really a catch-all, and just ensuring that there's nothing contrary or inconsistent from an audit evidence that may have led you to a different conclusion based on the information that you have. And we'll actually kind of get into that a little bit when we talk about the professional skepticism. From a code letter, it's time for the second code of this webinar, and that's going to be U as an umbrella. U as an umbrella. And hopefully the weather is better right now than it is right now. It's currently sleeting outside, so you definitely need an umbrella today at this point. So U is the second code. So let's talk about the PCAOB risk assessment momentarily. And I think it's just important to kind of just take a look back, as I kind of alluded to earlier. The risk assessment piece is something of a hot button. You know, we talk about it at our ANA updates. We talk about it as part of this training. And it's something that we can all improve on, and it's one of the things that we as a profession seem to be struggling with a lot. And one thing to note is that there is a presumed fraud risk over revenue transactions, and that's just written right into the standards. So it's something that you can't really get away from. I mean, it's presumed that there is a fraud risk for revenue. Management wants to drive up their revenue. But that doesn't mean that revenue is going to be the only fraud risk or significant risk for that matter. There's also other items that may be deemed to be a significant risk. And let's jump to the next slide and kind of look at what those factors might be that kind of point to what might be a significant risk. And on this slide are a number of different factors to consider when you're doing your risk assessment to identify potential significant risks. Is there business, the most common example, let's say like if we take the employee benefit plan world, for instance, would be like a plan merger or plan termination. It's probably going to be a complex transaction, and it's definitely going to be, it's going to be unusual, and it's probably going to be significant and unusual in nature. So as a result, I think the expectation would be is if you are an employee benefit plan audit and you have a transfer, a plan transfer of some sort, or plan merger, that's probably going to be a significant risk. Similar to the banks, if they do an acquisition, probably not something that is maybe not complex, but there might be a lot of judgment involved, right? Because there might be valuations involved. But it's definitely going to be something that's probably going to be an unusual transaction. So a lot of these, as you go through your risk assessment procedures, definitely take some time to think through what potentially could be a significant risk and ensure that that is appropriately documented within your risk assessment. And then to tie it all together, whatever you identify as significant risk, what are you going to do? You're going to put it on your required communications letter, and therefore complying with all of the appropriate PCAOB standards. So on this slide, we're looking at one specific paragraph, paragraph 75. It should include evaluation of how fraud can be perpetrated or concealed, presenting incomplete or inaccurate disclosures or by omitting disclosures. So it's pretty self-explanatory that if you have an area where the presumption of fraud, meaning probably revenue recognition, and you're going to exclude disclosures that could potentially be deemed to be of a significant nature, not only from a fraud risk, but also from a significant risk. But I think the reason why, the reason why it's bolded on here is because here's that complete inaccuracy. So they get you in the risk assessment to consider the fact that you need to make sure that you have complete and accurate disclosures as it relates to the overall financial statements as well. Okay, let's now take a moment to look at AS7, which is the Engagement Quality Review Standard. Again, this standard's not new, and it's been around for some time now. So it's really, this is just meant to be kind of a refresher for everybody on the call as to what engagements do require an EQCR from a PCOB perspective, and kind of which ones don't, and kind of the procedures and processes that go into the engagement quality review process. There are checklists that are available online. There's one for employee benefit plans, and there's also one for SEC-specific engagements for financial institutions. And the reason why there's a difference, there's obviously the financial institutions require different procedures than an employee benefit plan engagement review would require. For instance, obviously for an employee benefit plan, you're not going to be looking at the loan loss calculation in as much detail as you would be required to as part of a financial institutions review. And this slide, as you can see under AS7, all PCOB engagements, including broker-dealers, even if it's not filed with the SEC, are required to go through an engagement quality review. And this engagement quality review is relatively consistent with what you would normally see that comes out of from a PED extended review with certain procedures that are specific to PCOB engagement, like engagement completion document, review of independent standards, that may be a little bit more in-depth than what a normal EQCR would be for like a non-issuer client, if you will. But again, there's checklists that guide the specific engagement quality review partners through that overall procedure, and those are available on the ampersand. It does require an EQR as part of, if you are an issuer, as part of a quarterly procedure. So there will be quarterly EQRs that are done on 10Q engagements, and these EQR engagement reviews need to occur prior to the issuance of permission for an interim review for the filing of the Q, as well as the filing of the K. There's required to have obtained this form or verbal consent from the EQR to go ahead and file, and the approval of the report. And the point of this is twofold. It's to make sure that there has been a review of the work papers and the documentation of financial statements in accordance with the PCOB standards, but it's also obviously to comply with the overall PCOB standards more than anything else, right? Because that's ultimately what the standards are there for, to make sure that we comply with them so that we have an audit in accordance with PCOB standards. So who can do the review? It must be an associated person. For purposes, there is a lot more of an in-depth detail in the sense of if you don't have people out in the firm that can do the review, you can go outside the firm, and there's other requirements for that. But generally, it's really any sort of partner or partner equivalent within the firm can do it. So a principal could do this. It's really in a position of that has the appropriate requisition and the appropriate accounting skills and auditing and financial as it relates to the specific engagement. They must maintain their independence and integrity and really be objective. That's really the main key here is that there is an objective review of the specific work papers. What those specific work papers are that are reviewed really depends on the specific engagement. So for an employee benefit plan, there may be some more of a focus on investments. There may be a focus on participant data testing, whereas on a financial institution engagement, the focus probably is going to be on the loan loss calculation and maybe some investments testing versus looking at fixed assets or anything like that. It doesn't mean they have to look at every single work paper. It's really the significant risks. Also, as part of the overall review would be the required communication letters, any sort of governance communications that occur. The proxy report would be reviewed by the engagement quality review partner because that's filed with the SEC. The independence letter, as I had mentioned earlier, as well as any sort of documentation that relates to ensuring that the firm is independent as it relates to that specific engagement. All those documents are going to be reviewed as part of the overall EQR process. Now, from a overall qualification from a cooling off period, what does that mean? After 5 years, you are required to rotate off as the engagement quality review partner. So similar requirement to the lead audit partner. After 5 years, you're done with that client for 5 years. You don't have to do any sort of, you can't do anything associated with that client because of the independent SEC independence rules. There is also an independence rule that relates to if an individual is the engagement partner, they can't become the engagement quality review partner except for 2 years. So there's a quote unquote cooling off period as it relates to engagement partners who then try and become the engagement quality review partner. You have to be off the engagement for 2 years. So as we kind of talked about earlier, you're looking at the significant judgments and conclusions that support the overall engagement report. And you do this not only through reviewing the documentation, but you're going to hold discussions with the team. You're going to be part of that overall planning meeting. You will sit through that. You'll look at the risk assessment as part of that overall process, just to ensure that the audit is being done in accordance with the overall PCAOB standards. And once again, once you have done that, you have to make sure that there are no significant deficiencies as part of that audit, and that you are comfortable with the engagement team, and that your conclusions have been met, and any comments that you have been addressed by the engagement team in an appropriate manner. What does a significant engagement deficiency in an audit mean? It means that the team did not obtain appropriate evidence to support their conclusions in accordance with the standards. They may have reached inappropriate conclusions, and the engagement report is not in the circumstances. So if you had an employee benefit plan and the report failed to address the supplemental information, then that would be an issue, and you would not be able to provide your concurrence on that. Similar, if you had an entity that, let's say, had going concern and it was not talked about in the report, that would also be an item that would not be appropriate to have the engagement report, and would not allow you to, would be an example of a significant engagement deficiency. As well as if you identify areas where the firm is not independent, and as a result, we cannot issue an independent accountant's report in accordance with the standards. So again, that's just a high-level overview as it really relates to the engagement quality review process. To segue over into the staff audit practice alert number 10, this is maintaining professional skepticism. And again, this is something that we have talked about in the past. It's not going to be anything new. It's just, again, a general reminder to ensure that you are being professionally skeptical on your engagements. So if we take a look at a couple of the items on here, so for instance, the human biases, what does that mean, and why does that challenge us being professionally skeptical? And it really comes into, we can rationalize management's behavior, and we can rationalize why they act and do the thing that they do. We're programmed to believe certain things and not believe other things, and that's a bias that we need to be aware of. We're all under various scheduling and workload demands. Oftentimes we will just say, rather than push on what management's assertions are for, let's say, a specific investment or part of the loan loss calculation from a fair value standpoint for employee benefit plans, we would just say, you know what, let's just go with it. We'll just agree with what management's saying versus challenging them as to why maybe one of their investments in the employee benefit plan is a level 2 versus a level 1, or vice versa. The inherent audit environment demands, obviously we're in this to make money. We also are looking at wanting to make sure that our survey results and we have a high client satisfaction ratings, and oftentimes that may that have us bend a little bit towards being maybe a little more towards management and not really looking at it from a clear lens, if you will. And then obviously some of our clients have been clients for many years, and there's a certain level of trust. And I think obviously the SEC independence rules take that into place in the sense of you have a 5-year rotation schedule, so you're not able to maintain that level of familiarity with management for more than 5 years in an extended period of time. So what can we do on our engagements to ensure that there are appropriate professional skepticism on an annual basis? It's really a tone at the top type of thing. So being involved in planning and as part of the overall work from an audit perspective, from an engagement partner, as well as engagement quality review partner, and then just really encouraging the staff to look at things in kind of a challenging light, and to not just take what management is saying with an absolute, and really push on, well, wait a second, why are our broker-dealer fees down this year? If the market's really going up, there should be a lot more activity, and really challenging management's assessments and that sort of thing, and really looking at our knowledge and experience within the team to say, hey, if you are new to the engagement, you may have new insight or different experiences that may identify certain areas as to what might be different, and might also provide more challenging to management's assertions and their overall assumptions as part of the audit process. A couple other items to consider is obviously ensuring that our risk assessment is designed appropriately, and that we are looking at those incentives and pressures on management, and adopting our testing to address those specific items through our appropriate testing of standard analytical procedures, as well as tests of details, and just looking at all of the audit evidence in totality versus just at certain levels. So it's really to make sure that, are we seeing anything as part of the overall audit process that would lead us to believe something that may be inconsistent with some of the evidence that we're currently seeing within play. And a lot of this comes into play, this assertion really comes into play as it relates to going concern, as if management is painting this rosy picture of how everything is going really well, but let's say they have a significant debt payment coming up. Maybe that makes us step back a little bit and say, wait a second, your revenues are trending down and you have a balloon payment of debt coming up next year. Why do you think you're going to make it, right? Why are the assertions that you're using as part of your going concern analysis that you're going to grow revenues 3%? Does that really make sense? Does that really hold water in the grand scheme of things as it relates from an audit perspective? So let's do another code. Let's do N as in Nancy. So the third code for this presentation is going to be N as in Nancy. Let's now shift focus a little bit away from the other standards and kind of look at the independence rules and some guidance. And a lot of this is relatively familiar to everybody on this presentation, and really isn't going to be anything new. The PCAOB, as part of their overall inspection process and as part of the overall just review of the findings reports and reports that I've looked at, independence is still something that is being found on a lot of engagements. And so it's definitely something important to reflect on and make sure that everybody is still aware of that so that we do not, as a firm, run afoul of the overall independence standards. An accountant, and this is specifically right out of the SX rules, SX 201, and it says that an accountant is not independent if at any point during the year and professional period the accountant provides the following non-audit services to an audit client. So, for instance, bookkeeping, any sort of financial in IT design or implementation, actuarial services, outsourcing of internal audit, really anything that puts us in a management function. And we'll kind of look at that in a few slides as to what some of these examples might be from a broker-dealer side, as well as from some of our normal employee benefit plan and financial institution side. But this rule these rules are pretty much very similar to AICPA rules, but that being said, they are a lot more restrictive than an AICPA rule. So what you can prepare your financial statements of our clients in a non-issuer, non-SEC world per se. Obviously, the safeguards for Yellow Book might even be a little more restrictive than a non-issuer, straight-up manufacturing client. But from an SEC perspective, you cannot do it at all. You literally cannot touch those rules or touch those financial statements. So it's definitely a lot more restrictive from that perspective. And really, if there's a relationship that comes down and maybe it's not reflected in the rules, this is kind of the overarching 201 provisions that are out there. If there's something that creates a mutual or conflicting interest between us and our client, that is an audit client, from the SEC rule, the rules are going to say you can't do it. So for instance, if there's a business venture or where we benefit and our client benefits, that's a mutual interest or conflicting interest. We cannot do it under the SEC independence rules. Saying that there's something that would be putting us in a position to audit our own work. So, for instance, if we have a client that has an employee benefit plan, an actuarial plan, and we do the actuarial services for that, we would be in a position of auditing our own work because that actuarial report is going to be included in the overall financial statements, and as a result, our independence would be impaired as it relates to that client. The accountant acting as management or an employee of the audit client, that's something that we would cause us to be an issue if we are making management decisions. That would be something that would put us in a position to be part of their control environment. Wouldn't be something we'd be able to do. As well as being an advocate for the audit client. So if we're hired to be an expert witness or something along those lines for any sort of litigation, that puts us in we're advocating too much for the audit client, and therefore it would impair our independence. So the purpose of this slide is really to highlight the fact that we need to be independent throughout the entire professional period of engagement. So what does that mean? It's not just the audit, but it's also through the engagement. Once we sign that engagement letter, we're now deemed to be needing to maintain our independence. We need to be independent from the moment we send that engagement letter through the date of our audit report. That's really what the point of this first bulleted point from a slide perspective is doing. And the second one is really specific to the broker-dealers. A lot of the findings, and we'll get into it when we go through the broker-dealer portion of our presentation, that they continue to see instances where the broker-dealer engagement auditors are preparing the overall financial statements of our clients. So you can't do it as part of the audit. It's not something that you're able to do in the independence rules. So some other independence violations, as I alluded to earlier, from a broker-dealer perspective, the PCAOB has identified areas where the independent auditor was preparing and filing the focus reports on behalf of the client. That's obviously something that would violate independence, because you're acting as management by filing that report with the SEC. Also, preparing a portion or all of the financial statements, as we alluded to earlier, we cannot prepare drafts of the financial statements or anything with those financial statements as it comes for SEC clients. It's really something that we can't do. It's specifically spoken to or talked about within the audit guidance or within the SEC independence rules, that we just can't get near it almost. I think the other thing here too is that the bullet here, obtained drafts but made extensive changes. So maybe the client prepared, quote unquote, the financial statements, but we went through and did all this formatting and all of these added footnotes and put in dollar amounts. Again, that's too close. That's an independence violation as well. Also on here, providing valuation services we talked about, and then preparing the tax provision. We can't prepare the tax provision because we're, in essence, auditing our own work. So these are all, just keep these in mind from what we can and cannot do from independence rules. Now, we can always mark up the financial statements and provide them with comments back. That's allowed. It's just a matter of we cannot do any sort of like test or computer work associated, or any kind of like administrative writing or typing of the overall financial statements. We can, just to note, provide them with disclosure examples. So if as part of the new revenue recognition process that's out there, we're going to be going through on a lot of our broker dealers this year, we're still going to be able to provide them with examples of other broker dealer disclosures and footnotes that are available on the SEC website, or that we are getting through PPC or whatever the case may be. We're still able to provide them examples of what those disclosures look like, as long as it's a publicly available document and they would be able to get it on their own if they knew where it was or had the ability. They can obviously go out and find it. We can definitely provide them with those type of examples. It's just one of these things where we can't type it up for them and give it to them that way per se. It's really just pointing them to like, hey, here's what kind of like what it looks like. We can definitely do that, and we've always been able to do that, and providing good disclosure examples for our clients is definitely something that we should continue to be doing. One thing I do want to touch on here as part of the overall independence process is nothing that's really new for anybody on this call or new to the firm. For covered members, as it relates to people on these engagements, as well as partners and principals in the office in which the engagement is performed out of. I know a lot of our financial institutions are performed out of Syracuse, so many partners or principals in that office are deemed to be covered members. And for like employee benefit plans, the covered members are generally anybody in the Amherst office, because there's a lot of SEC work that's done out of there. There's SEC work done out of every office except for Albany at the point, but that obviously could change tomorrow. So it's important to note that you should be checking the financial institutions listing as well as the restricted stock listing. There is links in this slide deck to those specific items within where they are located on the ampersand. Let me just pause and give you a high level of the overview. The obtaining of a loan with a financial institution client, that is SEC, is prohibited for covered members. So you generally are not able to get a loan, a new home loan with an SEC client. There are certain exceptions to that for loans that you may have had that might be grandfathered in. So there may be some grandfathering clauses in there, but at this point we probably would know about them, or you would be aware of them if you had one of those situations. Also, owning a share of stock, one share of stock will impair the firm's independence as it relates to that engagement for any SEC registrants, as well as any non-SEC registrants, non-issuer clients, but that's something to point out. So SEC independence rules for non-issuer broker-dealers. So the bulk, I think our two broker-dealers are deemed non-issuer clients. They're non-issuer broker-dealers. So as a result, partner rotation, partner compensation arrangement, audit committee administration, and certain provisions for financial reporting oversight roles regarding like tax services performed, a lot of those specific rules we as a firm are not subject to them from an SEC perspective. We are, for our broker-dealers, there is always a parent involved, so the independence rules will still apply for the broker-dealer independence, but the parents of our current broker-dealers are non-SEC issuers. So, but they are subject to the broker-dealers are subject to the SEC rules, but not the parent. But it's just something to note that the partner rotation issues are not applicable as it relates to our current broker-dealer practice. So the next thing I want to cover is the PCAOB independence rule. This is the last one. This was SAP, Staff Practice Alert number 14, improper alteration of audit documentation, issued in April of 16. Ultimately, the easiest way to sum this slide up is just don't alter audit documentation, especially when you know that the firm is going to be, the work papers have been requested by the PCAOB or have been subpoenaed. The most infamous case that's going on right now is the KPMG case. Is really what prompted this practice alert. And this was the case, if you're familiar with it, that had 6 CPAs. A number of them worked at the PCAOB or in some capacity and obtained the specific listing of clients that were going to be selected as part of the inspection process at KPMG. So they went in and altered a lot of the documentation prior to the PCAOB inspection, and as a result, the findings went down from a PCAOB findings perspective on those engagements, and KPMG received a more favorable report than in the past. And once this was determined, a lot of the individuals were barred from practicing before the SEC due to the PCAOB ethics violations. So if just don't do it. I mean, there's really no good can come of it. And I know this is specific to SEC engagements or PCAOB engagements, but don't do it for non-SEC engagements either. The last point on this slide definitely is very true. The consequences of improper alteration are much more severe than the actual audit deficiency. I mean, these people's careers potentially are ruined to a large extent because of what they did. I think there's more of an ethical issue in the sense that they knew about it and they tried to do things to get ahead of the curve, if you will, which were not appropriate. But just from an overall, just don't do it. Just not only from this perspective, but also from an ethical, legal perspective, it's definitely a negative as well. So before we jump into the Broker-dealer update portion, I'm going to give you the next code, which is going to be N as in Nancy. Again, that's N as in Nancy. All right, so we're in the home stretch of this presentation. And now we're going to shift the remainder of this presentation is going to be speaking to our broker-dealer practice. And so a lot of the slides on here are going to be are from the PCAOB's broker-dealer conference, and it really focuses on a lot of their broker-dealer inspection report that they issued in in August 20th of 2018. And this is there's a link right there on the slide presentation to the overall report. The specific report is relatively thick, probably about 65 pages long. Goes into a lot of detail and a lot of analysis as it relates to their overall inspection process, the findings that they had, as well as a lot of the deficiencies for both carrying and non-carrying broker-dealers. So just for people that might not be familiar with this, currently our broker-dealer practice consists of only non-carrying broker-dealers, and that means that our broker-dealers do not hold the overall investments. They shift that over to a third party to maintain all of the accounts. So the impetus on carrying broker-dealers is a lot more testing involved than from an audit perspective than non-carrying dealers, as well as a lot more risk. So the scope of their 2018 report covered periods that ended 6/30/16 and 6/30/17. So it did have a 12/31/16 audits as part of that overall process. This is their fourth year of operating the overall program, and it specifically shows that of the overall 116 audits that they did look at, there was about 79% of them that had some sort of issue, either be it an audit deficiency or an attestation deficiency, as it relates to the specific PCAOB auditing standards. And those overall findings can really be broken down into kind of four major categories, if you will, at least as they relate to our specific practice. And those are over the auditing of revenue and the assessment of risk material misstatement over revenue, and the information produced by the company, the broker-dealer in this instance. And you'll see that the completeness and accuracy was one of those findings as well. And then also specific to that, the financial statement disclosures, a lot of going concern, because a lot of these non-carrying broker-dealers are very minimally capitalized. So there was a lot of issues that the PCAOB gleaned from a going concern in the disclosures over that and testing related to that, as well as the review procedures on the exemption report, and then also the auditing of the supporting schedules and the net capital computation, and some of the testing that was related to that. So if we jump into the overall revenue perspective, the risk assessment was an issue on 26 of the audits that were inspected. There was revenue testing issues on 38 of the audits inspected. So between the risk assessment and the risk assessment of revenue and the revenue testing, there was a significant number of findings as it related to this. And one of the specific findings that they had they're kind of outlined on here is sufficient understanding of the broker-dealer environment. And that's really specific to the overall key products that were used by, or that were sold by the broker-dealer, as well as their specific sources of revenue. Also, there was a failure of the engagement team's part to understand management's process and management's risk assessment over internal controls on revenue from a fraud risk perspective, and the overall internal control environment as it related specific to revenue. As we kind of talked about earlier in this presentation, the risk assessment was not completed appropriately by engagement teams for revenue. It was done at the audit area level or the financial statement level versus the relative assertion level, looking at all the assertions that impact revenue and doing a risk assessment at that level of detail. There was also some journal entry testing. surrounding the testing over revenue and how do they get comfortable over management's processes and procedures, as well as the completeness and accuracy of the overall revenue size. Specific to the sampling, there was findings as it related to the number of journal entries that were tested, and ensuring the appropriate documentation as it related to that sample size and the testing performed. From a sufficient test of details, it's important to note, as everybody on this call is aware, that just doing substantive analytics is not sufficient for revenue. There needs to be some level and test of controls or test of details as it relates to revenue. So a lot of times, if you go back to your old accounting or your audit class days, you got to fill your bucket with test of controls, test of details to gain comfort over the overall risk associated with a specific area. And so the PCAOB, as part of their inspection process and their evaluation, their analysis was that there was just not sufficient testing of procedures and details, and there might have been too much reliance on controls. And if there was too much reliance on controls, then there wasn't enough testing of those specific controls, mainly surrounding the overall sampling size and the sampling procedures. So how do we get comfortable with this from an audit perspective? It's really using these PPC templates of 8.1, 8.2, and 8.3 as they relate to the sampling techniques and from a substantive procedures. These are the PPC templates for audits of broker-dealers. That is specifically the references in here for the PPC templates and where you would be able to find them. As a reminder, if you are doing controls testing on a broker-dealer, to make sure that if you do mark a control as less than high, that you're ensuring that you do appropriately test the controls. I would probably venture a guess that the majority of our clients, our broker-dealers, are small to where we do not provide any sort of reliance on controls. We will go through and obtain an understanding of the control environment as required by the PCAOB standards, but we're not going to go through and test 40 specific controls, because we're just not going to get that additional level of comfort on the overall control that we're trying to test. From a substantive procedure perspective, some of the firms did not do the requirements under AS 2305 as it relates to the substantive analytical procedures. There was no expectation that was developed, and if there was an expectation that was developed, it wasn't sufficiently precise enough to identify those misstatements. And just for an example of what that means is, let's take last year. The market was relatively up for the most part. The expectation that was developed oftentimes said the market's up, so our fees and revenues are going to be up. And that's not really a precise analytic, right? I mean, it seems to be a more precise analytic would be our fees and revenue associated with the commissions on stock and stock transactions is going to be more sufficient or higher than in years past because of the market movement. And as a result, when you go through and you apply that substantive analytic, you're able to look at the overall relationship and say, yep, based on the testing that we performed, that is correct and it is appropriate. And that's at a good level of detail to where we're able to support it with outside information. Meaning you can look at the S&P and see what the S&P did versus just making a broad statement of, yeah, the revenue is going to go up. It's not sufficient or precise enough. Also, the completeness of and accuracy of data. Once again, that's here. That's on this slide. That is something that continues to come up throughout the presentation. So here it is once again. And I think the other ones are kind of self-explanatory. 9.1 on this slide is a PPC template in broker-dealers, as well as any of the other PPC suite of products that you can use to provide additional comfort, and it will help you work and design through the specific use of substantive analytics. So consideration use of a service organization. So for our non-carrying broker-dealers, they use a service organization to clear a lot of the transactions. And so as a result of that, there are specific procedures that we need to perform. And those procedures are outlined in AP 1A, as well as we need to have documentation over the user controls, and then we also have to test the accuracy and completeness of the information. Looking at 2601, some of the missteps that are referenced in the inspection report by the PCAOB was that there was no testing or completeness or accuracy of the data. There was no evidence of user controls, and ultimately the information just was not relevant to the overall audit that was being performed. So just some things to keep in mind as we start our broker-dealer engagements, to just make sure that we are addressing these items within the overall testing of our broker-dealer engagements. Shifting over to the financial statement disclosure process, the findings here relate to related party transactions. There was no identification of them or evaluation of if there were related party transactions. There was no revenue recognition policies for material levels of classes, which kind of goes back to one of the earlier findings of there not being a understanding of the revenue transactions and revenue processes. Fair value disclosures, there's no evaluation of leveling classifications, so just ensuring that we have audit evidence in the binder as it relates to the leveling of the transactions. And then obviously going concern with the new ASU that came out last year and that was in play, there's been a lot of significant analysis and push on the going concern disclosure, as well as the documentation of the going concern consideration, just because of the new ASU. So it was definitely something that a lot of engagement teams fell down on as part of the inspection report, that there might not have been sufficient documentation, or there might have been disclosures when there were instances of going concern that were not included within the financial statements. For the review engagements, we just have to ensure that there was, for some of the findings, there was no assessment of fraud, there was no understanding of the financial responsibility rules that were referenced within the review report, as well as the compliance requirements, or there was no test of those controls or lack of controls over compliance. Might not have been there at all. And one more little plug for completeness and accuracy. There it is again on why there was no testing. For our engagements, we're looking to see CX 16.8 within the engagement binder, which will cover the specific review procedures. So if we complete 16.8, that should cover us on all of the required procedures that would be looked to be performed for this specific attestation engagement for under AT2. Lastly, the auditing, the supporting schedule, the net capital computation. For this one, there was testing issues surrounding the following areas. There was no testing of the minimum capital requirements. There was no testing over the allowable assets, the haircuts, operational changes, deductions, or anything else that went into that specific net capital computation schedule that's attached to this as supplemental information. Within PPC, there is AP2 audit program for general auditing and completion. That covers the requirements under the PCAOB auditing standards as it relates to supplemental information. So by completing this specific work program within your engagements, you will appropriately be in compliance with these specific auditing standards as they relate to broker-dealer engagements for the auditing of supplemental information. As a result of this, 28 audits for the net capital computation were found to be deficient as it relates to their auditing of supplemental information. Okay, now I have one more code to give you, but in order to make sure that we can get an hour and a half of CPE, I'm just going to go through a couple last minute items here, and then we'll go ahead and give you the code, and then we should be all set. For any broker-dealer questions that you may have, there is, obviously PPC has a lot of PPC templates, a specific suite that is dedicated to the broker-dealer engagement, so we can definitely use those and leverage those. For any questions that you may have as part of this consultation or part of this webinar, they've either been answered via the chat box that's been monitored, or you can feel free to reach out to me subsequent to this webinar to just provide me with any questions that you may have, and I'll be more than happy to go ahead and answer those. You either call me or just go ahead and email me, and we can take it from there. And then the last code that you need is going to be Y as in yellow. Again, that's going to be the last code is Y as in yellow. And I think with that should end our time together. Appreciate it. Thank you very much. Have a good one.